so on the Robinson-Huron Treaty Territory and the traditional territory of the Tikmishing Anishinaabe, Wanapate First Nation, and the ancestral homeland of the Métis Nation. Following yesterday's interest rate announcement, we are pleased to host Toni Gravelle to discuss the bank's policy actions in response to COVID-19 pandemic and how these policies and other recent developments are taken into account during the bank's interest rate decisions. During this presentation, you are welcome to ask questions by typing the question into the question box on the right of your screen. These questions then will be answered by Mr. Gravelle following his remarks. Today's event is proudly presented by Technica Mining. Thank you very much for your continued support. We are also pleased to recognize other sponsors for today's inaugural virtual President Series event. They include our silver sponsors, Stingray Radio, Rewind 103.9 and Hot 93.5, DST Consulting Engineers, and Pioneer Construction. Our bronze sponsors, Fisher Wavy and Baker Tilly SNT. Thank you all for your generous support. We very much value your commitment to your local chamber and all the work that we do here. I would also like to acknowledge that our Northern Ontario Chamber Network is joining us today, with chambers from Thunder Bay, Sault Ste. Marie, Timmins, and North Bay. Now I'd like to introduce our special guest, Deputy Governor of the Bank of Canada, Toni Gravelle. Toni Gravelle became Deputy Governor of the Bank of Canada in November 2019. In this role, he oversees the bank's financial system activities and shares responsibility for setting monetary policy. Mr. Gravelle first joined the bank as an analyst in 1996 and went on to hold various positions within the Financial Markets Department, becoming Managing Director in 2015. In addition to his extensive research experience at the bank, Mr. Gravelle served as the General Director of the Financial Sector Policy Branch at the Canadian Department of Finance from 2013 to 2015 and was an economist at the International Monetary Fund from 2002 to 2005. Mr. Gravelle is a native of Corbeil, Ontario, and holds a PhD in economics from Western University. Thank you for being here today. Mr. Gravelle, the floor is yours.
Thank you. Good afternoon, ladies and gentlemen. It's a pleasure to appear before you today to talk about the current economic situation and how the Bank of Canada is contributing to the eventual recovery. Even though I can't be with you in person, I'm excited to have the chance to return, albeit virtually, to my roots in Northern Ontario. I grew up on a farm in Corbeil, just outside of North Bay. I worked at my parents' meat shop, which is where I developed my interest in economics and markets. I also have family in the Sudbury area. C'est durant ma jeunesse dans le nord de l'Ontario que j'ai appris que c'était grâce au travail acharné que le Canada est devenu l'un des principaux exportateurs de métaux communs. Parmi ces métaux figure le nickel, le produit de base qui a fait connaître Sudbury. Les technologies d'extraction minière et les technologies de fusion avancées utilisées dans votre région contribuent à maintenir le pays à l'avant-garde de la production de métaux communs à faible coût. My formative years have served me well throughout my career, and they continue to inspire me in my role at the Bank of Canada, where I help lead the work around financial stability as well as financial market functioning. You can probably imagine that my job has shifted quite a bit, given recent market turbulences. The COVID-19 pandemic poses extraordinary challenges to Canada, to Canadians, and to the economy. This has required extraordinary responses, both from a fiscal and monetary policy perspective. In the short term, we need to keep credit flowing and financial markets working so households can continue to pay their bills and companies can cover their operating costs. And as we move from crisis response to recovery, we need to maintain a well-functioning financial system. That way, our policy actions get through to people and businesses. In turn, when the containment measures are lifted, the recovery will be easier to attain and sustain. Today, I'd like to discuss some of the specific programs the bank has put in place to achieve both of these goals. That is, to ensure funding liquidity and market liquidity. I'll also provide you with some early results we're seeing. Finally, I'd like to talk about our interest rate announcement yesterday and how the actions we've taken will contribute to the eventual recovery. So what does liquidity mean and why does it matter? Imagine that you're doing your weekly grocery shop, but when you get to the cashier, you realize you don't have your wallet. Even though you have lots of assets, maybe a house or a car, or if you're in Northern Ontario, probably a boat in the driveway, you can't quickly or easily trade those for milk and bread. You are in a liquidity crunch because you don't have the cash on hand to buy the goods and services you need. Similarly, the financial system can only function smoothly if people, companies, and governments can borrow the cash they need to operate. And this borrowing is only possible if financial institutions, the source of this cash, have access to borrowing themselves in wholesale debt markets. This is the essence of funding liquidity, being able to quickly and predictably borrow money in markets or from banks. Separately, we also refer to market liquidity, the notion of being able to sell assets quickly without offering a large price discount. Participants in financial markets depend on market liquidity to be able to manage their asset and cash holdings by trading large amounts of assets at predictable prices. As you can see, market and funding liquidity work hand in hand in normal times. Institutions that need cash can get it by borrowing from or selling assets to other institutions that may have surplus cash. But in a crisis, everyone is looking to get more cash. Those who have cash may hoard it, and liquidity dries up. Le manque de liquidité crée de l'incertitude et des perturbations dans l'ensemble du système financier. Résultat, il devient plus difficile et plus coûteux pour les ménages et les entreprises d'obtenir du financement au moment où ils en ont le besoin le plus. Et cette situation peut aggraver les effets globaux d'un choc économique à grande échelle et ralentir la reprise. Alors, parlons de la pénurie de liquidité qui est survenue au moment où le coronavirus nous a frappés. Vers la fin du mois de février, lorsqu'il était devenu évident que la COVID-19 prenait des allures de pandémie mondiale, les perturbations se sont intensifiées sur les marchés financiers. De plus en plus de pays à travers le monde sont entrés en confinement et les prix sur les marchés financiers ont commencé à refléter un ralentissement économique. It's important to remember that we've never experienced a shock of this nature before, so markets were gripped with uncertainty about how long the downturn might last and how deeply Canadians would feel its impact. As you might guess, markets hate uncertainty. When uncertainty invades the mindset of market participants, they tend to put more weight on the worst-case outcomes for the economy and asset valuations. In early March, as the scope of the lockdown became apparent, there was a rush to the exits where market participants sold financial assets in a panic. Markets began to seize, they weren't functioning well. Because everyone was looking to sell assets and secure cash at about the same time. This generated a sharp increase in volatility and a drying up of market and funding liquidity. This demand for cash or liquidity was system-wide. It affected both those who wanted more liquidity and those who supply it, such as banks. Because the problem affected the whole system, the Banque du Canada responded swiftly with a broad suite of programs. At the outset of the pandemic, and within a span of about 3 weeks, we cut our policy interest rate from 1.75 to 0.25%. This is as low as we think we can reduce it without causing problems for the financial system. Réduire le taux directeur permet de stimuler l'activité économique en diminuant les coûts du financement. Nous nous rendons bien compte que ces baisses de taux n'entraîneront pas beaucoup plus d'emprunts et de dépenses pendant la phase de confinement. Mais cette mesure aidera les particuliers et les entreprises à assurer un service de leurs dettes et préparera le terrain pour la reprise. De plus, l'abaissement du taux directeur est tout à fait conforme à notre régime de cible de l'inflation. Nous savons que pour l'inflation revient à la cible de 2 %, il faut stimuler la croissance économique et l'emploi. But even while we were cutting our rate, we could see that the financial system was running short on liquidity and credit wasn't flowing properly. So the bank deployed some other tools from our toolkit. We started by addressing immediate funding liquidity issues that were gripping our financial institutions. We knew that by helping with funding liquidity, banks would be able to meet more demand for credit coming from people and businesses. So we ramped up our repo operations. Our repo provides funding liquidity to financial institutions for a set term backed by high-quality collateral. In normal times, we use repo to manage our balance sheet. They are part of our regular business operations. We typically carry out term repos once every 2 weeks for amounts of between $3 and $6 billion, and for terms of 1 or 3 months. However, during the crisis, we cranked up the volume to 11 to allow the banking system to tap directly into the much-needed funding liquidity. The Banque du Canada increased the frequency of our repo operations to twice per week and for much larger amounts, peaking at $24 billion per operation. We broadened the list of financial institutions we engaged with and the type of collateral we accept. We also extended the terms of our repo operations for durations of up to 24 months. En s'installant, la crise a causé non seulement des tensions sur les flux de crédit, mais aussi un assèchement de la liquidité de marché. En d'autres mots, tant que les acheteurs et que les vendeurs restaient en retraite, les prix étaient redevenus hyper volatiles et ne reflétaient pas la réalité des conditions économiques sous-jacentes. Dans bien des cas, les investisseurs avaient commencé à exiger des primes importantes pour accepter d'acquérir des actifs plus risqués. This called for the bank to bring out brand new tools from its toolkit. Our staff worked incredibly hard to take 6 purchase facilities that existed only on paper and turn them into reality, and quickly. To ease strains in key short-term funding markets for Canadian companies, we started programs to buy bankers' acceptances and commercial paper. And more recently, we began a program to buy up to $10 billion of high-quality corporate bonds in the secondary market. We also introduced programs to support liquidity and well-functioning markets for short-term and long-term provincial government borrowing. The Banque du Canada has taken one other very important action in response to the COVID-19 crisis. I'm referring to our large-scale asset purchases of Government Canada securities in the secondary market. These purchases are supporting the liquidity and efficiency of this foundational market. Like the repo operations I talked about earlier, we buy these assets as part of our normal business operations. This is because we need to have assets on our balance sheet to match our liabilities, which normally consist mainly of banknotes. What's different is the scale of these purchases. We are buying at least $5 billion of securities per week, and we will continue to do so until the economic recovery is well underway. We focus on the Government Canada bond market because the market sets the baseline for the entire fixed income market. For instance, the yields of a 5-year Government Canada bond are an important determinant of 5-year fixed mortgage rates. In normal times, when it is working well, the government bond market reflects that investors think about the economy and future interest rates. But when this market isn't working well, it makes it harder to price other assets. Il est d'une importance vitale que les marchés de titres de dette du gouvernement canadien soient au milieu de leur forme. Ainsi, les mesures prises par la Banque, qu'il s'agisse de relèvement de notre taux directeur ou de sa réduction, se transmettront à l'économie et nous permettront de mieux atteindre notre cible d'inflation. Tous les programmes que j'ai mentionnés ont pour but de préserver l'activité des marchés d'emprunt, de donner à ceux qui en ont besoin un accès à des fonds et de procurer de la stabilité pour rassurer les Canadiens. Nos mesures ont fait grossir le bilan de la Banque, qui est passé d'environ 120 milliards de dollars au début du mois de mars à plus de 460 milliards aujourd'hui. It's not new for central banks to expand their balance sheets to satisfy an increase in need for liquidity. In fact, this is the key reason why central banks were established, to be lender of last resort, providing liquidity across the economy. But some people worry that this expansion of the balance sheet will lead to runaway inflation. In this environment, we are more concerned about low inflation and potentially deflation, given the depth of the economic downturn. We want to make clear that we still have our policy rate at our disposal if inflation were to heat up. It can be raised to influence borrowing costs, credit growth, and economic activity, regardless of the size of our balance sheet. While all the programs I've mentioned and their effects on our balance sheet, I'm sure you're wondering what kind of results we're seeing. We published our financial system review a few weeks ago, and we included some early indications. I'm pleased to report that many key financial markets that had been showing signs of significant liquidity stress now appear to have good functioning restored. Bid-ask spreads and yield spreads in many markets have narrowed significantly. This tells us that market liquidity has improved. In addition, financial institutions now have better access to funding liquidity in markets. This has had positive, measurable impacts on Canadians. In the early days of the pandemic, when lenders had a hard time accessing cash, they passed along their higher borrowing costs to the people and businesses who wanted to borrow from them, even as the Banque du Canada's policy rate fell. After having our facilities in place for some time, lenders can now readily access the funding they need in markets, and we've seen mortgage rates on new loans start to decline. Furthermore, many of our programs to support financial markets are being used less and less as conditions stabilize. That is why we announced yesterday that we will scale back some of the facilities we put in place. In particular, we are reducing the frequency of our activity in markets for both term repos and bankers' acceptances. These are positive early results. Governing Council will continue to ensure we use the right tools for the right job and that our response is proportional to the level of financial system or economic risk we see. The bank is prepared to augment the scale of any of its program if needed to support market functioning. And if further monetary policy stimulus is required to meet our inflation target, the bank has the tools available to deliver that stimulus. Let me now turn to the economy and talk about the discussions that led to our monetary policy announcement yesterday. Just to recap, we announced that we kept our policy rate at the effective lower bound and maintain our commitment to continue large-scale asset purchases until the economic recovery is well underway. In reaching this decision, we naturally spent a great deal of time talking about economic data we have seen since the pandemic hit. The incoming data confirmed the severe impact of the pandemic on the global economy. It looks like this impact may have peaked as countries are starting to reopen their economies. Financial conditions have also begun to improve, but we know the reopening process is going to be long and uneven, and there could easily be setbacks. In terms of the Canadian economy, let's remember that we came into the crisis in relatively good shape. The Canadian economy was operating at close to capacity, our national jobless rate was near a 40-year low, and inflation was near target. To be sure, regions such as Sudbury were feeling the impact of lower commodity prices, and in particular, oil-producing regions were getting hit by another dramatic drop in oil prices. Some temporary factors, including rail blockades, teacher strikes, were also weighing on growth as we headed into March. Puis est arrivée la pandémie, et il est tout de suite apparu clairement que son impact économique allait être profond. La semaine dernière, nous avons reçu les données des comptes nationaux pour le premier trimestre de l'année, y compris le mois de mars, où les fermetures ont vraiment commencé. Ce rapport montre que l'économie s'est contractée de 2,1% durant les trois premiers trimestres de l'année. Pour le deuxième trimestre, nous attendons à ce que le niveau de production soit encore de 10 à 20% plus bas. As bad as that sounds, this outcome would be in the upper half of the range that we estimated in April's monetary policy report. So far, we have seen employment plunge at an unprecedented rate, with 3 million jobs lost through April. However, the last labor force survey from Statistics Canada shows that 43% of the people who have lost their jobs since February said they expect to return to it. This suggests that many of these people may be back to work as the containment measures are lifted, although this is by no means assured. By comparison, only 15% of Canadians who lost their job during the global financial crisis in 2008-2009 said they expected to return to the same one. Inflation, meanwhile, has dropped close to zero, driven mainly by falling prices for gasoline. We expect that temporary factors will keep inflation below the target range in the near term. However, we know that the Consumer Price Index, or CPI, is not giving an accurate picture of inflation for many Canadians at the moment. That is because the weight of the goods and services in the CPI are fixed. And during the shutdown, some items, such as gasoline and travel, are simply not being consumed as they usually are. However, our measures of core inflation have declined only slightly to a range from between 1.6% to 2%. This is not surprising given the core measure generally removes the impact of the most volatile prices in the CPI, such as gasoline. Naturally, my colleagues on Governing Council and I talked a lot about where we think the economy will go from here. And we saw some reasons to be hopeful that the worst can be avoided. First, we noted that a gradual reopening of the economy is starting in most areas of the country. Spending on cars and houses has picked up, and measures of consumer confidence have increased from the low levels recorded last month. Further, we see signs that fiscal support measures put in place by governments have been effective in supporting income. Obviously, being laid off is a painful experience, even more so during a pandemic. And the amount of income support available varies from person to person. That said, the income support announced so far is scaled to replace the labor income lost across the economy. What is more, government measures are helping people remain attached to their jobs. This will be absolutely critical for supporting the recovery. Finally, as I noted in this speech, there are clear signs that credit is flowing and the financial system is working well. This will be another key piece underlying the strength of the recovery. Despite the positive signs, though, many risks and uncertainties remain. A lot will depend on whether we as a country are successful in managing the risk of possible future waves of COVID-19 and the pace at which containment measures are lifted. This applies to the global economy as well as Canada's. We will be paying close attention to how the pandemic is affecting growth and demand in key markets for Canadian exports. As we get more data, we will have a better sense of the impact of the containment measures. These data will help us answer a number of important questions. What's going to happen with business and consumer confidence? Will the pandemic lead to lasting change in household saving and spending habits? How many companies will be unable to reopen their doors, and how many job losses will be permanent? How quickly will these people who lose their jobs be able to find other work? How will companies adjust or rebuild global supply chains, and so on? Ultimately, the stance of the bank's monetary policy will depend a lot on what happens to the balance between what the economy can supply and what people demand, because this will affect the outlook for inflation. It is possible, for example, that economic supply could recover faster than demand if business reopens quickly, but consumers remain cautious. In the lead up to our July NPR and beyond, it will be key for us to understand how the pandemic has affected demand, employment, and the economy's capacity to produce goods and services. As market function improves and containment measures ease, the bank's focus will shift to supporting the resumption of growth and output and employment. Any further policy actions would be calibrated to provide the necessary degree of monetary policy accommodation required to achieve the inflation target. À mesure que le fonctionnement des marchés s'améliore et que le déconfinement se poursuit, la Banque déplacera son attention sur la reprise et la croissance de la production et de l'emploi. La Banque maintient son engagement à continuer ses achats d'actifs à grande échelle jusqu'à ce que la reprise économique soit bien entamée. Toute nouvelle mesure de la politique sera calibrée de façon à fournir le degré de détente monétaire requise pour atteindre la cible d'inflation. Thank you very much for your attention. Now I'd be happy to take some questions.
Thank you very much, Mr. Gravelle. So we do have some time for some questions now. I see a few are slowly coming in. Don't be afraid to ask in the chat box on the right of your screen. So we'll jump into it here. I see a few. So the first one, what does the bank expect in terms of GDP growth in Q3 and Q4 2020, assuming that there's no vaccine?
Well, as we mentioned in our press release yesterday, we currently expect that the economic growth will return in the second half of this year. This is based on our assumptions about the current rate of confinement, how the economy is opening up already. And it's not based on necessarily on the need for a vaccine. It's just basically based on the degree of social distancing and how that's being opened up over time.
Okay. Next question. What impact do you think the increased business debt incurred during the COVID-19 will have on the economic recovery?
So, I mean, we've mentioned a few times that we're worried about both household indebtedness and increasingly about business debt in terms of the financial system vulnerability. What we've seen during the pandemic, or at least, is that the government programs have been in place to ameliorate the situation for many businesses going forward. And there's many programs where business have access to preferential either debt that is offered at preferential rates, or in some programs, there's a little bit of a grant involved as well. In terms of going forward, we're totally cognizant that the higher debt levels will be incurred, but given that that in many respects, banks, commercial enterprises need money in terms of keep going and keeping their operations open, and to take advantage of the opening up of the economy. We're hoping that the debt they take on will actually ensure a very robust recovery in Canada, and that recovery will engender a much stronger economy, and that will allow them to be in better place to pay down that debt as the economy is more vigorous.
Okay. Next question. Once fully recovered, do you expect the USMCA agreement to change the Canadian economy in any significant ways beyond what the status quo was under NAFTA? I'll just go back to what our previous governor, Pola, said, is that free trade is always beneficial to the economy, and trade agreements allow for a much greater freedom of goods to go across borders as well as services. The new free trade agreement was put in place in a period where Canada was actually under threat of having less free trade given without a free trade agreement. So the positive, or the benefits to free trade are clearly clear in the sense that it enhances economic growth, to the extent that in comparison to the current new free trade agreement versus the old one, I think that the large advantages that we gained in the old one will be kept, and there's a few areas where there's a modernization of certain aspects of free trade that weren't included in the previous free trade agreement, largely in services, that will also add some benefit to various parts of the economy. Okay. Many municipalities are suffering from critical budgetary pressures during this time. What impact do you think this will have on local economic development and on municipalities' ability to borrow?
Well, it's clear that municipalities are being hit, being in the front line of many of the essential services, if you will. And we are heartened to hear that that the federal government has provided extra funding that was announced earlier in this week. We're hoping also that our programs, especially our provincial bond program, buying program, will help market functioning in provincial bond markets, as well allow for provincial provinces to borrow money at a better rate. All that should, in principle, support provincial funding as well as municipal funding, given that there's an interaction or a link between both of these.
Okay, I think we have a few more questions coming in. How do you compare the challenges for the bank during the pandemic compared to the 2008 recession?
Well, this is very different from the global financial crisis in many respects. Just for example, during the global financial crisis, we put in much fewer new facilities to support the financial system. Basically, we extended term repo and cut our interest rate. During this crisis, we've implemented the same program, term repos, but we've done 6 other purchase programs, as well as a few other facilities, as well as cutting interest rates. So just on a financial system basis, this is a much more severe impact. In part, the severity comes from the speed of the panic or the speed of the severity in financial markets. In terms of economic contraction, Well, we don't have all the numbers in, but if our estimate for Q2 in terms of the economic contraction line up with what the outcome will be in terms of StatsCan numbers, that too will be a much more severe contraction that we saw in the 2008-2009 recession. Mind you, it's very likely that, at least in terms of that the rebound dynamics might be a bit more quicker, although there's a lot of uncertainty here, and there's still many paths in terms of the recovery, as we outline in our April NPR.
Okay. Next question. With the tensions between the U.S. and China, how do you see it impacting the Canadian supply chain and the Canadian economy?
Well, global trade tensions, if you will, or global tensions that affect trade and globalization will have an impact on various supply chains, be it directly or indirectly, to the extent that certain products are made in China, go through the United States, and then are an input into Canadian products. And any degree of deglobalization, if you will, always engenders structural changes that are costly in the short term, at least, and will have moderately negative impacts. It's really dependent on how strong those structural changes are and how quickly Canadian firms can adapt to these changes.
What sectors do you think are poised for growth when the economy finally reopens?
There too, it's a little bit hard to tell. It's clear that there's going to be some structural changes in the economy. There's going to be some sectors that are going to be harder hit and maybe longer hit over a longer term period. Think of airlines, for example. Some of the restaurant sectors, some of the tourism sectors will be hit much more. But again, the path of the recovery is not quite known. There's many paths through the recovery. It's very likely that some sectors that have been hard hit are like food, like restaurants, tend to have there's a lot of restaurants that appear and disappear on a regular basis in normal times, to the extent that dynamism in restaurant business is maintained. You can see that change and rebound quite quickly, for example. Other sectors that are indirectly dependent on the ones I just mentioned might also feel the impact. But again, Canadians are quite innovative, and you can see many of the firms adapt. For example, retail is adapting very quickly to online presence. As such, you can see some other adaptation across other sectors.
Okay. How does the bank take into account decisions by key trading partners, both by central banks like the U.S. Federal Reserve or the European Central Bank, or by public health authorities in those countries?
Well, I mean, we look at economic factors that affect the Canadian economy. So to the extent that other central banks have policies that affect global interest rates, for example, or current foreign exchange, we take that into consideration in our policy analysis. In terms of public health, there too, to the extent that all we take in is actually the degrees of how confinements are being relaxed, the state of relaxation of those social distancing impacts on the economy in that country. Not directly, we don't really take into account the policy of relaxation, confinement relaxation per se.
Okay. I think we have time for, looks like one more question. This pandemic has really brought into focus China's role in the world economy and its influence over other critical supply chains. How do you see things changing for Ontario's economy moving forward versus China, or if at all?
There too, again, I mean, the Canadian economy and Ontario's as well, we're really relying on global scene, the global macro economy. We both export to various parts of the world, and we also import various inputs into the stuff we make or the stuff we dig out of the ground if you're in Sudbury. play a factor in that. I mean, the evolution of China, at least up until a few years ago, was that it was providing low-cost goods and low-cost services. As that becomes, as that sort of, that kind of dynamic changes, either because they've become better at certain products or more global in nature, that's beneficial to the economy. I'm going to stick to the economic side to the extent that certain products are being, certain aspects of the Chinese economy become less dominant and other countries come along and become better providers or cheaper providers of goods, like India, for example. That's a continuously evolving dynamic. And of course, political economy issues affect that sort of economic dynamic, but I don't have a really clear view on how political economy might affect global economic dynamics going forward.
Okay. Do you have any last remarks before we conclude here today, Mr. Gravelle?
No, I want to say thank you again I was hoping I'd be in Sudbury for this in person, catch up with my family a little bit, but it was not to be. Looking forward to having a chance to be back in the Northern Ontario area in the near term.
Okay, great. So again, just wanted to say thank you to the Deputy Governor Toni Gravelle for joining us today. As our token of our appreciation, the Chamber will be making a donation on your behalf to the Greater Sudbury Chamber of Commerce Post-Secondary Student Bursary Fund. These bursaries are distributed at the end of the year to deserving students at each of our member post-secondary education institutions here in Sudbury. So thank you again to Mr. Gravelle for sharing your remarks with us, and to our generous sponsors, our title sponsor, Technica Mining, and our other sponsors, Pioneer Construction, DST Consulting Engineers, Stingray Radio, Rewind 103.9, and the Hot New 93.5, Fisher Wavy, and Baker Tilly SNT. So on behalf of the Chamber, thank you all for joining us today, and we look forward to your continued support in the future. And thank you again, Mr. Gravelle.
Thank you. Have a good day.
Take care.